मनीष सर स्टार्ट करिए।
Good evening, everyone. This year, 2020, many have been written off as the year of non-event. But the way I see, I think this is the year of rebooting yourself, dedicating your time to learning and updating your knowledge. WRC has taken a lead under the leadership of Sri Lalit Bajaj and organized and planned many virtual webinars on various topics, which has helped immensely benefited our professional brothers. And the benefit of that webinars will be seen in years to come in the working and quality work of our professional brothers. I request Sri Lalit Bajaj ji, Chairman WIRC, to say a few words about the activities of WIRC. Sir, over to you.
Thanks, Manish. Expert on the subject, CA Nikhil Sharma, core group member of the Research Study Circle, Manish Vora, seniors, friends and colleagues. On behalf of WIRC, I welcome all of you in this August gathering of investor awareness program, wherein it is organized by WIRC and hosted by the Research CP Study Circle. At the outset, I congratulate the Research CP Study Circle for coming ahead and ensuring that this program can be successfully planned. Today's subject is market outlook and decoding of asset class. I think so technically, when I speak to younger chartered accountants, I have generally observed that analyst or analysis is one of the area wherein lot many younger chartered accountants are interested to enter into. And I think so today's session will really help them to enlighten on some of the aspects as far as asset classes are concerned. As you all know that there has been influx of demat accounts in last 6 months because lot many retail investors have entered equity market. And I think so we as chartered accountants, as consultants, we has a larger role and larger duty as to ensure that they are properly their investments are properly complied, and at the same time the investments are safe. So I think so the whole basic idea of investor awareness program is to update the various requirements, basic traits, the analyst point of view and the technicalities, because at the end of the day we are making or we are losing our hard-earned money, we ourselves or our clients. So I look forward for an enthralling session in the next 3 hours. And once again, welcome all of you, and thanks the Research CP Study Circle for joining and ensuring that this program can be successfully conducted. Thank you a lot. Thanks.
Thank you very much, sir. Sir, thank you very much for your kind words. Our Honorable PM, Shri Narendra Modi ji, has set a vision to take India to a 5 trillion economy, and there are various factors that will lead us to a desired goal. But one of the prime factor to reach to a 5 trillion economy is strong investment climate and robust dispute redressal. There are many government agencies like MCA, SEBI and other departments which are focusing on protecting investors as well as developing conducive climate for every person to involved in the economy or in the system to take the benefit of channelizing money and growing forward. Government has formulated various laws to protect genuine investors, and at the same time we are conducting an awareness so that investors take informed and right decisions which add to their wealth. And to take us through today, we are young and aggressive CA Shri Nikhil Sharma ji. About the speaker, he will take us to asset allocation and decoding of investment, decoding a market. And I think he has done his about our speaker today. He has done his articleship from Inger and Associates during 2009 to 2011. After clearing his CA in 2011, he is associated as a managing partner of Pranam and Associates LLP and a partner in Pranam Business Consultant. His area of practice is in specializing in customized support to ultra HNIs and HNIs. He advises in wealth protection, will planning, estate planning, smooth legacy transfer, business succession planning, and global wealth management. Looking at his experience and profile, I think he's a correct person who will really take us to investor awareness program and will give all bullet points or maybe many things which we might during the years we might have forgotten. So I request our today's speaker to start his session and request everybody to welcome him. And so please start your presentation.
Thanks, Manish, and thank you, Lalitji, for the warm welcome for me. So, should I start with my presentation or like what is?
Now, Nikhil, you can start with your presentation about on the topic of today. I think the screen sharing we are starting.
So, like, is this visible to you? And I'm sure, like,
Yes,
will be visible
I can
to
see.
all
I
of.
can see a financial hospital complete. I think
You
financial
can
planner.
you can see my screen, right?
Yes, I can see you. I can see the screen.
Yeah. So I can start.
Yes.
Thanks, Manishji, once again. So, good evening to all my colleagues, and thanks for ICI or WIRC for giving this kind of opportunity, like a young chartered accountant like me. So, it is very interesting topic, like decoding of asset class and more or less on market outlook itself. So I'll start first with the market outlook so that you can correlate, this market with, asset class, and then we can talk more on asset allocation. So to see market outlook, first we will see like what happened till so far or what kind of event occurred in last 6 months. Um, to be very open with you, this 6 month, the last 6 months was the time in this in this field where I can say that I have learned like what I haven't learned in last 8 years. So this is a time where a lot of things came out, and lot of surprises came out. So surprise is always good when we can learn from that. So I'll start first with like what happened so far, so that will take it ahead. So market के अंदर like market outlook के लिए it is very important to understand like what event is happening or what event is happened. So I'll start with lockdown because I would like to talk more on the recent data, not the last 5 year or 10 year or three years. So recently, the biggest surprise for Indian economy or global economy is lockdown. So yes, that was a surprise for us, and that was a surprise for the market itself. So if you'll see the growth forecasting of all major countries, including emerging country, they all revised like in the month of April itself. It all revised and revised with a great margin. Like if you'll see India, the growth prediction was 6%. That will come to 2.1%. I'm talking about the data of April 2020. So all of the country, has revised their growth forecasting for FY 2021. So yes, that was the biggest surprise medical outbreak for Indian economy as well as the global economy. So like through this lockdown, what happened? The global economy's indicator is weakening up. So due to that, there was a bear run in major global indices, and that we have seen in the month of March and April, the biggest outbreak in the Sensex as well as the other country like USA and UK, their index also was on the bear run. And more or apart from this bear on the economic this market side, there was a big disruption on the manufacturing sector. And to be very frank, like Manishji mentioned about 5 trillion economy target of India, so I think manufacturing was the sector which our Prime Minister, Mr. Modi, is looking for, and they are much focusing on make in India so that they could achieve the target of 5 trillion economy by 2022 or 24. So this sector hits very, very, very deeply. Like there was a biggest uncertainty on this sector wise, like how they will open again, and how many years it will, or days it will go on this kind of lockdown. So there was a major disruption of the supply chain and the manufacturing unit. So the most suffered unit, according to me, was the manufacturing sector. And and the most important part was the uncertainty of the duration. So the impact automatically will be uncertain because the duration of this lockdown and this COVID-19 medical emergency outbreak was uncertain. So that was the biggest surprisingly factor was uncertainty. Uncertainty on the market, global market, including all the manufacturing sector. So yes, so we were in the situation where we don't know where we are moving forward until how many days it will continue like that. So that was a major event happened. Then we'll talk about like government is trying to cover up the things by doing spending more and more, and with this government stimulation point of view. So government has announced COVID relief package of 1.7 trillion, and after that 20 trillion INR. So this 20 trillion INR is something like 10 times of our current GDP. So I'll read out some glimpse of that is stimulation. So I'll cover only the economic stimulation, which is correlate to our topic itself, because that was there are the other parameter also on that part. So economic stimulation में the RBI and government दोनों ने आके एक सिंक के अंदर काम किया, and I have covered both the important point which was relevant for us to understand the market and what happened due to this government stimulation. So the major thing is like this repo rate reduction that was important for India, because I said manufacturing hits so hard, and all of the manufacturing sector like steel or cement or some other infra, they all are running on that high debt model. So their debt, they all are the debt driven industries. So there, like this 135 bips in last 1 year reduction of the repo rate was the biggest relief by the RBI, and repo rate is low at 4% as of now. And tomorrow, like from 2nd to 4th, there is another MPC policy meeting is due. So they may hold the same rate, or they may increase this. That is up to them. But till so far, they done a good job. They reduce the interest rate. However, by doing this interest rate reduction and all these things, RBI has to see what is the inflation or CPI index. So touchwood, they are able to manage both the things, CPI index and this interest rate, both things under control as of now, and that was the lowest in India for at the rate of 4%. Then again, RBI has reduced CRR from 100 basis point from 4% to 3%. So this move infuse a lot of liquidity in banking system. So बैंक के पास में जो एक CRR उनको रिजर्व रखना होता है 4% का, उनको 1% का जो लेवरेज दिया, उसकी वजह से उनके पास में लिक्विडिटी काफी अच्छी इंप्रूव हो गई. एंड वो लिक्विडिटी का इम्पैक्ट लाइक आई कवर लेटर इन माय स्लाइड्स कि किस तरीके से वो इंडस्ट्रीज के पास और मैन्युफैक्चरिंग के पास में जा सकती है. बट यस, लिक्विडिटी के ऊपर अच्छा काम किया आरबीआई ने, एंड दे रिड्यूस रेट फ्रॉम 4% to 3%. Again, liquidity coverage ratio also they reduced from 80% from 100 to 80%. And this is the most important thing, like you all have heard that government has announced 3 lakh crore collateral free loan with 100% government guarantee. Then moratorium periods come into the picture. RBI has announced moratorium period, and in fact the case is going on in Supreme Court where we are demanding like waiver of the interest. So that is again an interesting part. Yes, so this is the biggest relief of banking and financial sector or NBFC sector, where they have relaxed the norms of the NPA and they allow to restructure of the bad loan. So I'm talking about the point where government has taken the steps to revive the economy and to help otherwise if any bank NPA कुछ increase होगा उनका NPA का certain percentage, so they are in the side of where RBI can take the action on the default or something. So RBI has released all the norms where this kind of panic situation can be handled. So again, in the last point of this, default has been increased from rupees 1 lakh to 1 crore under IBC, that is in insolvency and bankruptcy code. So ये जितने भी measure है, in my opinion or my view, has been taken to help the MSME as well as the corporate sector by both RBI and government has taken this initiative. And as far as talking about taxation stimulus, so there are various due date has been extended. I am sure you must be aware about that, so I have not written so much deep into that. Then reduction in TDS rate, like by 75%, they have reduced the rate of the TDS for this financial year. And this is again interesting, this PLI scheme. Till so far, what data I have seen is not done like good so far about this PLI scheme, but we are hoping so that a lot of manufacturing or export oriented industry will be benefited from this product link incentive scheme. So this was the event where the government has announced so many stimulus. So talking about lockdown, talking about government stimulus, in that scenario, we have seen some good kind of things. That was the Q2 result. After a fall of 27% top line and 40% steep fall in profits in Q1, we have seen a great recovery in the Q2. You can see the chart where Y on Y we have a recovery in the PAT 46.2%. That is very good and fantastic according to me. And if I exclude the bank, as I explained, like bank are the most beneficial sector from the RBI, stimulus or the government stimulus, because their books has been increased good. They are allowed to do restructuring, and their CRR ratio has been reduced. And so if I exclude BFSI sector, still there is a impact. There is a 37.6% Y-on-Y growth. So I see like this Q2 result give us a hope, and what we have seen the rally in the market in last 2 months, it is supported by Q2 result. In my view, the rally started with the liquidity and then supported by the earnings of the Q2, and there is a hope that Q3 and Q4 will be not as bad as we are looking for. So if you see in this Q2 result, there is a profit growth 3x to Y-on-Y growth. We have seen like 46.2%, and this is the first time when Nifty listed companies profit crossed 1.45 CR record profit. But if you see, like there is a sales down by 6.3%. That was down by 27% in Q1, but still there is a Y-on-Y 6.3% sales shortfall. So we haven't grown in the top line, but we are able to manage the good profit, very good profit, I'll say. Why so? Because like in my view or in my research, because we adopted well this new norm, and most of the companies shifted their model on the cost saving or the profit making center. So they reduced the rental cost from their balance sheet. They reduced some of salary extent. They reduced like traveling cost. They reduced so many other costs which they could. So I think that is the best optimum utilization I can say from the corporate side, and they are able to manage the bottom line on the higher side despite like there is a fall in the sales top line. So that was a good hope. And US election happened. Yes, US election or relation with US is very important for us to understand, or to judge Indian market. Why so? Because India is a trade surplus with US in relation. So we have a trade surplus in 2019-20 of USD $17.3 billion. So it is a very good amount as a export things or trade surplus thing. So in an export thing, we done so far 53 billion in 1920, and we imported 35.7 billion. So there is a net surplus of 17.3 billion. And what I understood from this data, the historical data of last 20 years, we always every year we are on the surplus side. But 2017 was the highest surplus year for us. But still there is a hope with US relation, our trade surplus should increase. Then trade in service, if I'm talking about, so trade in service majorly we are dominated export service country. So our India counting or our India share from US service import is 5% of their total import from out of the world. So that is a good number, I can say. In a service side, we are dominating this sector for USA also. For investment point of view, again, USA for us is the fifth biggest source of FDI, and one third of total FPIs belongs to US. So in FPIs is basically where they invest into financial asset. So this FPI number is more interesting, where one third of the total FPI, come from the USA. So that US election was the point where we can see there should be proper certainty, and so that we can define our new relationship with US. So in my opinion, it's good that Joe Biden is come, so that this H1B visa, which is indirectly for trade in service most affected sector of IT, can be in a good shape as of now. Because if you'll see this H1B visa, Mr. Trump has suspended that arrangement with us, and they started American first to their corporate to prefer over the foreign employee. So if Joe Biden policies are in favor of the globalization, so India will be the most beneficial in the point of view of IT and education. So this US election was important for us, and I have given you the data point why it is important to view, to see the relationship with way forward with USA. Now the inflows FPI, which I talked about, USA is a one third participant of this, but this is very interesting for us to see. If you see inflow of FPI YTD till so far, so there was the biggest sharp downside in the month of March on 23rd. So you will see most of the FPIs has taken out their money, and that amount was something around 65,000 crore of rupees. So they have pull out all the money, and you see the steep fall here. And the same thing, if you see this building in the month of November, so they again invested 65,000 or so also amount. So there is a sharp rally in the market. So with this chart, my assumption and my research or my opinion, make most stronger, because I see the rally in the market is the liquidity driven rally. So liquidity has been wiped out in the month of March, and that has been taken back. So that start supporting the equity market of India. So this is liquidity driven rally. Liquidity in terms of FPI has infused the money. Lot of domestic investors in the month of April or May. I have heard that we are the record individual retail stock portfolio has been opened, and MP has reported that so many new folio has been generated. So the local retail participation was, supporting Indian economy in the month of April, May, June, and then FPI number come in the month of November. That is the record high. So I must say that that is a liquidity-driven rally, and it is so because in Indian banking channel also a lot of fund has been infused. So yes, I must say that that is a liquidity-driven rally. And you will see in the month of November, as I'm talking about, that is a record number of FPIs come in the month of November. The total number till so far is 65,000 crore, and it is as equivalent to the YTD number till so far. So FPI number was good for Indian economy, and that liquidity has been infused by FPI as well as domestic investor. But domestic investor in last 2 months, if you'll see, there is a gross negative thing, because people are doing profit booking and they are removing their portfolio. So that are the event happened so far. So now after discussing this, I think I'll move forward. What is the way forward thing, or what thing which we should look while doing or seeing this market outlook. So there is two questions come into the mind. First is, this bullish trend will continue because liquidity is good and FPI is infusing money. In fact, today's market created a very good high, and or the other point is correction, whether correction is expected, because still top line is 6.3% minus, and correction is expected because the P of the market is something somewhere around 35 to 39. So if top 50 companies of India, Nifty 50 I'm talking about, there be something 35 to 39 times. So it is still it is really a expensive market. So correction may be expected. So I think we should first know this 5 or 6 question answer in our mind, that will decide like this bullish trend will continue or there is a correction expected. So if the liquidity going to be continue in next two quarter, so I think this bullish trend can continue. Otherwise, if liquidity is wiped out at any point of time, then I think so that correction we can see the correction, and that correction cannot be alike in the month of March, because the biggest difference is that was the surprisingly factor or uncertainty factor was working. That was not only the criteria of liquidity. There was a lot of uncertainty, lot of people are in a dilemma that what will happen, and that was mostly the surprise was there. So today there is no surprise as such if the second wave will come or not. So there is no surprise. We all are well prepared about like what will happen, and we the touch wood we have adopted a new norm in well and a great way and efficient way. So I think liquidity will decide. This is one of the factor which will decide whether this bullish trend will continue or not. Then most important thing, like I'm talked about this P. So P, there is two factors coming working. Like first is the price which we have seen in the market, and the other is earning. So Q2 earning is giving a hope that Q3 and Q4 will not be as bad as we were expecting at initially. So if earning will going to be improve in next Q3 or Q4, then yes, we can support the valuation, and P may come down to somewhere around 35 to 25 times. So that will again good balancing point. Then as I said, like this banking sector is or will play a crucial role in this market outlook. So till so far RBI has relaxed the norm of the NP, and they allowed for the restructuring or reclassification of their loans in their books. So the most interesting thing would be the Q1 of the next financial year, where the real NPA number or real balance sheet will come out, to see like how dent on the bad loans on their books. So that will be again the key points which will decide on this trend or this correction side. Then again, COVID vaccine, till so far news is very good. Like most of the countries has done with their third trial or something, and India is also in that race. So I think this COVID vaccine news is the positive from my side, and they are supporting the bullish trend. Then RBI monetary policy, that is due from tomorrow to any day they can announce between 2 to 4. So RBI monetary policy is important because RBI need to control the inflation, as well as they need to keep the rate on the lower side, so that they can support more on the economy side with the government stimulus. So RBI monetary policy will be again the key to watch out this thing, and mostly or prima facie they are supporting the government policies. So I think this RBI monetary policy will be in line with the government things. And most important thing is government stimulus will be continue or not, because till so far government has done a fair job in my view, but it should not stop here, because government should be the one who can come out and spend fair in this kind of uncertain thing. So government stimulation should be continue to revive the entire economy. So with the answer or with the analysis of this 6 question, we can decide our bullish trend or correction. So this is about the market. But if you'll see the valuation trends, so I'll show you one report. This I extracted from the Morningstar platform. So if you'll see this report or this chart, this indicate the performance of the global index, where India is also into the green. So this green is indicating those who have given or written more than 20%. So this is the data of the 1 year. So in 1 year, yes, because this last 2-3 months was super fantastic. India has also delivered the good return, the same in line with the other major countries like USA and China and the Russia, or this Europe has some problem, but most of the countries or most of the India has given good return in last 1 year. But if you look at the valuation, so valuation I have divided in three parts. One is the 1 year. You'll see like 1 year valuation for India as a country. So it was undervalued. It was undervalued. This blue area, light blue area is the undervalued indicator. Simultaneously, if you see the US market, that was fairly valued, denotes to zero. Then if you see 3 months valuation of the global index or the market, so India become green. So green indicates the zero. It means the fairly valued. And if you see the US, it will become overvalued or more than the fairly valued point. But if you see the most recent valuation, this most recent valuation is showing that India is also under the orange kind of thing where it is overvalued. So as per the Morningstar research analysis report, India is overvalued as of now, or I can say in easy word, it is expensive as of now. So it is expensive, but it is continue to be expensive or not, that we have discussed in our last slide. That is important thing to know, because we need to see the way forward thing, not the past thing only. Past thing can give us the glimpse or the idea where we can do research, but that question answer which we have discussed in the last slide is most important thing. Who will decide like whether this bullish trend will continue despite we have seen the overvaluation in the market, or the correction will come because market is overvalued. It is as simple as that. I would like to go through you all about some numbers of the GDP. In the month of April, this is the report, or this is the extract of the IMF report. IMF released their forecasting about all the countries on economic world outlook. So their report says that India's GDP will grow in the month of April by 1.9. Then they'll see the impact of the lockdown in India, the uncertainty. They revise the forecasting in the month of June by 4.9%. That for this year, India economy or India GDP will degrow basically at the rate of 4.5%. Then again they revise the data in the month of October, and they are saying that we will be degrow more than what they expected in the month of June, and that data is degrowth of 10.3% of GDP as compared to last year. But also they have announced, or they have declared in October forecasting, that India will bounce back by 8.8% growth rate for next financial year, that is 2021-22. So with this data, if you compare with other country of this October report, so India is the country like if I compare it to US or China or UK or Germany, which is the largest GDP country. So our degrowth forecasting was the higher than that country, like USA 4.3 and China 1.9 positive, UK 9.8, and India is 10.3. So this is, and the most important and the most interesting factor of this report is that India is the only country, major among the developed countries or the good emerging country. It is the only country where degrowth is higher than the earlier report. All or the other countries are in the better shape. That may be due to because Europe has started lockdown initially or early as compared to India, but that was a surprising factor for us. And not only IMF report, the other leading agencies like Moody's and Twitch and World Bank and RBI and S&P, they indicate that in 2021 we are estimating that our GDP will be degrow, our top line will not increase as much, and that are between 9% to 11.5%. So they have made a statement that it was due to June quarter fall Q1 number were there at that time, and 40% steep fall were there at that time. They were seeing that our demand has been collapsed and investment has cost plunged, and real per capita income has been declined, and so and so. That was their statement. But how India bounced back? V-shaped recovery. Why V-shaped recovery? these are the two, 3-4 points which is giving some boost for this point, like V-shaped recovery. The first and foremost thing is new norm, which we adopted as a working culture. And due to this new norm, we have seen in Q2 result, earnings is better than 46% as compared to Y-on-Y. That is again a good sign for Indian economy to bounce back. And we have shown that yes, we can adopt the new norms, and that can be taken as a opportunity in tough time. And that tremendous job has been done by the corporate side. I'm talking about market point of view, not in a political or other point of view. Then this FPI and FIIs, this number of the November especially, 65,000 crore. Like if I compare that number, November itself, that is equivalent to YTD data, and it is highest number in a month. So that is again a good liquidity infused in Indian index. So that give boost to the Indian market and supported this V-shaped recovery. And then that's great that festival has come, and we enjoyed well and we started spending. And for any country, spending is more important, because if the money is keeping lying in the home, so it will not useful for any of it will not survive, or it will not deliver the purpose. So great festival season, and we are seeing that it will continue. So whether it will be Christmas or the New Year or so on. So that is the reason, like, market touched their new high, and these all are the reason who is backing the V-shaped recovery or Indian economy. But again, the question is whether this V-shaped recovery is sustainable or not, whether this bullish trend is sustainable or not. So the answer will be, I have given to you that 6 question which we need to answer, and we need to track. Nobody in the market can give you like that correction कल का कल आ जाएगा या फिर bullish trend रहने वाला है, यहाँ से market 50,000 दिख रहा है. Personally, I see that is all are the prediction based on some data, and data may be wrong, and prediction almost 99% it went wrong. So we need to stick to the fundamental, and we need to stick to the point where we can have that fundamental answer. So again, like, we have seen like what happened till so far, and we have seen like what is way forward we need to track. But you see that investor point of view, it is very time consuming thing, and investor do really have that much of time where he can put their hat to answer this kind of queries and questions. So I think this decoding asset allocation is the perfect thing to match with the market outlook, because that is the only thing that you can survive with any kind of market, whether there is a bullish trend or a bear trend. If you have a proper asset allocation, then you can survive. So now I'll come or start covering this asset allocation thing. So my view, asset allocation versus timing the market, that is a hot topic. Like someone saying that I have a tip, if I bought Reliance at the point of 800 when it went down. So, and if I could sold in 2300 when it was so much high, so I could make somewhere around 2.5 time returns. So my question to them, or my question to anyone, those who is thinking like that, whether you are aware that Reliance will came down to 800 and will bounce back to 2300. And if you think that 2300 was the highest point, you should sell, or you should wait for to achieve 2400 or 500. So in market, we can't predict that is the highest point or that is the lowest point. We can just predict we are near to bottom, or we are near to bottom or near to the higher side. So doing this kind of activity, timing the market, we can easily save our energy, and we can easily find a solution. So let's see if someone is thinking like timing the market is a good thing. So I have something to show them, like winner always rotate. So this is the data of 2010 to 2019, where you have seen the top performer on the top side. Like in 2010, gold has delivered 24% return. Again, 11 gold, 29%. But in 2012, you have seen that mid cap rally has came, and he has that rally has delivered 38.52%. Then international exposure came, and then 29.6, small cap 62%, credit risk fund delivered in 2015 10% return, GSEC in 2015. Why GSEC in 2016 15% return? Because there is a sharp fall on the repo rate side that give boost of the GSEC return. Then small cap 59%, then gold 8%, amongst all the asset classes where all are into negative, mid cap, small cap, international equity. This gold is delivered 8% return. In last 2019, international equity again 27.31% return. So the moral of the story is winner is always, rotating banner. Winner is not the same, those who were there in the last year. सो विनर के पीछे भागेंगे मेरे हिसाब से कुछ नहीं मिलने वाला है. विनर हमेशा रोटेट होता रहता है. विनर और लूजर किसी के भी पीछे भागने से आई डोंट थिंक सो दैट विल हेल्प अस. सो चेजिंग अ विनर इज अ गुड or chasing a loser is a good idea. So here is some data for you, and this data is from 1993 to 2019. So it is a good amount of year of data. So if you are chasing a winner and investing based on the last year best asset class, so you could land on the CAGR of 5.38%. On the other side, if you are chasing a loser, like जो सबसे नीचे रहा है, हमें लग रहा है अगली बार ये बाउंस बैक करेगा या फिर सबसे सस्ता लग रहा है, हमने उसको चेज करते हुए लूजर के अंदर पैसा डाल दिया, तो हमने रिटर्न बनाया 6.53%. But if we have a fair idea on the asset allocation and we are able to manage equal weight asset allocation, so we could achieve 8.17% of return. So that is my point, and that is the moral of the story. Like if you are chasing a winner or loser, I don't think so that is a good idea. Or in other way, timing a market, never a good idea. Now talking about risk and return by choosing a good asset allocation. So this asset allocation, I divided into risk and reward, two part. So this risk and return, if you'll see, like if I invested my money, again the data is from 2003 to 2020. So if I'm investing my money 100% in debt, because I'm not aware about the asset allocation, and I'm a very conservative person, and I invested the entire money into debt. So in these area, I'm able to generate 6.70% return with a minimum standard deviation that denotes to risk is 4%. And if I could, if I'm a very aggressive person and I am investing entire money into equity, then if you'll see the return is 18.5%, but standard deviation is 26%. So if you'll see the near column, if I'm doing simple asset allocation like 30% into debt and 70% into equity, I am able to manage the same kind of return equivalent to 100% equity with a less standard deviation, less risk. The same thing 50-50, 14.9 and 18% standard deviation, and 80-20 is 10% and 11%. Again, this is the historical data. I'm not saying we need to repeat it like 30% debt and 70% equities will deliver you the 18% return for the next year or next quarter or whatever goal period you have. But this give me a glimpse that yes, risk and reward we need to see very closely, and we need to do a proper asset allocation that will suits for a profile of investor, and then only we should suggest or we should start investing. It is not like that I'm aggressive, so I should start everything is into equity. So that was my point. So risk and return point of view, also asset allocation is important, and timing the market is not a solution. Proper asset allocation is a solution, because winner every year will rotate and rotated in past history. So like covering this asset allocation versus timing the market, I would like to take you ahead on the what are the asset class available and what are the asset class to to have a fair idea about the asset class. So there are typically we divided broadly into 5 asset classes, and there is no fixed guideline that we segregated into 5 asset classes. There are so many methodologies available where you can see 4 asset class or 6 asset class. So here we have 5 asset class. I covered like this 5 asset class to discuss more into that. So the first one is equity. So to understand this asset class is why important, because we need to identify the purpose of each asset class. For example, like I can't tell that asset class to deliver me double-digit return, because the purpose is something else for that asset class. And the same thing apply to liquid asset class, or this real estate asset class. I can't say estate asset class, to give me liquidity. Like I have 1 crore of rupees for 1 month, and I would like to buy one house. So in very next day, I would like to liquidate it. So it is not possible. So there are characteristics of each and every asset class. So it is very important to choose asset class. First, we need to understand, what type of asset class we are choosing. So I'll start with equity. So the product or the avenues available in equity is direct equity. You can open demat account and you can start investing in direct equity, direct stock of any of the company. Then there is PMS. There is new terminology called AUA. AUA is asset under advisory. Because we all are chartered accountants, so I'll advise you, start practice in this area also, because asset under advisory, if you'll see, you have to apply some RIA license to SEBI, and SEBI will permit you to do advisory to individual. So asset under advisory is, it is a kind of thing. It is a small PMS where you can call your client to invest money on your based on your advisory. So that is again a unique thing which we can focus on. So this asset under advisory is also the part of the equity form. Then direct equity international, you will see a lot of traction in this area, this direct equity international, because although because US market, there are little bit uncertainty on the political side, but I am sure it will be settled in the month of Jan or Feb. So and we have seen their equity is also fairly overvalued, so that will also settle down over the period of 2-3 months. So this direct equity international platform, you'll see more and more channel will come on this part. So right now Stockel, one of the company which I know, is doing, and some other platform also where you can do this direct equity trading, not trading, investing or trading, which we will discuss. But you can have share of Amazon or share of Facebook or share of Tesla. So that is a facility is available as of now, or that mechanism is established in India as of now. So you can look for these avenue for equity asset class. Then unlisted equity, that is very yeah, or I can say is fastest growing sector in this equity theme, where unlisted equity people are now willing to invest into unlisted equity. So for example, like SDFC has their subsidiary company of SDB. So that is not listed on the stock, but we know that that is backed by SDFC. So they have a strong foundation and strong mechanism and strong book. So these kind of unlisted equities share also traded in secondary market, where you can buy and sell. Then private equity, again, it is a good growing sector, where a lot of private equity came into the picture, and they are investing on Indian INC. Equity mutual fund, ETFs, etc., are very known, I can say, the avenues for the equity. Derivatives is also one of the kind of the equity. So in my view, this equity should have a purpose, and that purpose could be investing, and that purpose could be trading. But one thing which we should know, there is a difference between trading and investing. So the same difference will apply for the speculation and wealth creation. So if I am doing for a purpose of investment, so my purpose is to create wealth. And if I am doing trading, so that purpose is speculation, nothing else. So you need to define your purpose while doing your investment itself in this asset class as a equity. So if you would like to create wealth, you have to go for the investment, not for the trading. There is a huge difference between investment and trading. There is like a separate, I can say, session can be taken on difference between these two strategies. So the feature of this asset class is it is highly volatile. It is highly volatile because it is directly related to economy or the sentiments of any country. So this is highly volatile. So choose accordingly. Those who have aggressive kind of thing, risk appetite, can go for the equity. How much I'll cover in like next slides or in some time, like when it will come. Historically outperformed any other asset class. So yes, equity, because it is highly volatile. So he has a capacity, to deliver a more return as compared to any other asset class. And historical data saying that equity has outperformed other asset class. But there is a downside also. We can see negative return. So we should have patience when we are choosing this asset class. So negative return is the feature or the characteristics of the equity. So if we are choosing equity and we are seeing I have a loss, so there is no big surprise should come from your side, because you have choose equity. Those have a feature to deliver negative return for some period. So you have patience for that, or to make it into positive side, or if the fundamental is bad, we could exit also. So due to this high volatility, there may be a negative return or positive return, but that is a feature of the equity. And as I mentioned, it is directly linked to the economic growth of the country. If we are saying that India will grow, or we all are participating very hard to for the growth of the our country, and we witness that we have potential to growth, give growth to our country in a uh, more than 6 or 8% kind of return. And $5 trillion economy target we already taken, like we means our prime minister has already announced. So if things well happen, so this equity can deliver a good return in next couple of years. But yes, it is linked to the directly linked to the economy. That's why it is highly volatile. And yes, in India, it is very tax friendly. Like 3 years back, it was more tax friendly. I must say it was tax free for equity asset class, because at that time, long term capital gain was tax free. But after their amendment also, it is tax friendly, because we have benefit of grandfathering. We have benefit of rupees 1 lakh exempt income as a equity, exempt capital gain as a equity for long term. And after that also, there is only 10% tax rate. As compared to any other asset class, the tax rate is very high. So in my view, it is still tax friendly, not that much that was it 3 years back, but still amongst the other asset class, it is still tax friendly. So this is the equity, that is the purpose which we should choose before choosing this asset class, and that is a feature. So I'm sure we all have fair idea now about the equity and its feature, and we should define the purpose. Now we'll move to the debt asset class. So as I initially or starting, I said you each asset class has their different purpose. So for this debt asset class, these are the avenues available. But main purpose of this asset class is not to deliver the return. This asset class has a specific purpose to give the stability of the portfolio. For return, if you are choosing this asset class, so we are taking a higher risk than equity. For example, if you have seen ILNFS and Yes Bank, um, uh, in debt, like specifically in debt mutual fund, where we do not have a control, like where our money is going to invest. So if you'll see, there is one category in debt mutual fund, that is credit risk fund. That credit risk fund usually deliver a return of 9 or 10%. So tell me one thing: if debt asset class is giving you 9 or 10% return, and we are expecting from equity 12% return, so I'm sure we all will say that we should move to debt asset class, because it is less risky, and we should take 9 to 10% return. We will be happy. We are not required 12% return. We are happy with lesser than 3% return. But in my view, that 9 or 10% return is taking a risk higher than equity asset class, because we witnessed in ILNFS case where entire capital is wiped out. So biggest risk on this asset class is default risk. So due to this default risk, we should choose a right debt product. because our purpose to have this asset class is to give stability of the portfolio, not the generation, generating the more returns or more profit. Yeah, sure, we can link that we should beat the inflation return, but we should not be more greedy in this asset class, because the risk they will take to generate a more return in that asset class will be higher than the equity asset class, because in equity there is not, in equity we have a chance there, we can see the negative return of some period, but in that asset class there is a entire capital is on risk. So that is my advice to you when you are choosing this asset class. So your purpose should be giving some kind of stability of the portfolio, because this is the less volatile asset class. So this is less volatile asset class. Have a quick look on what are the avenues is available. So there is a fixed deposits, very traditional debt product. Then there is a bonds. This bond, you mark my word, in next 2 or 3 years, you will see this avenue is it will be developed very maturely, and you'll see buying and selling of bond as equivalent to equity. So right now there is a bond trading happens, but it happens in the secondary market. For example, like someone like for example Nikhil have some kind of bond and I would like to sell, so I will approach to any of the broker. First I will sell, or I will transfer to their escrow account. They will find some buyer for me, and they will transfer my bond to their my bond to them in their demat account, and that all happens offline in secondary market. So the real price of the buying and selling is still hidden. So as a seller, I'm not aware like my bond to whom it is selling, it is available, but at what price it is selling, it is not available. And for the same side, for the the investor, those who is buying is not aware from where he is buying or what is the price, actual price of that. So that is the secondary market. But I feel that it will soon will the open up, and we'll see a lot of open trading in the bond market, and it will be a mature market in next 2 or 3 years. That is my opinion. So this bond has the capacity to deliver a good return with a lesser risk to as compared to the credit risk fund of the mutual fund side, because you have control on your bond, like which so let's say you have filter to choose like which bond you would like to choose. So first filter you would like to have triple A rated bond. Okay, then triple A rated bond, you have a filter, you can choose only the PSU bank or PSU sector companies. So this kind of filter you can apply, and you can reduce the risk of default, and then you can choose your right bond. Then EPF and PPF, depending upon like you are salaried or you are professional. So give me a moment, like there is one notification slow network connection. I can do that. I'm sure like I'm audible to all of you. Manish, till so far like I'm audible. All right, I assume that I am audible to all of you, so I'll continue this. Yeah, so bond will be a mature market in next 2 3 years. You will see EPF, PPF. We have I explained like depend upon your salaried or non-salaried or professional. So you can go for PPF. PPF, there is a tax-friendly mechanism. So yes, you can take advantage of that. But interest rate risk still there, because in PPA we have witnessed that repo rate has reduced 135 basis point. So that effect we have seen on PPA. Now the rate is somewhere around 7 point something. I'm not sure the exact rate, but the rate has been reduced from 8% to 7% something in PPA. NSE post office, again, this is the debt instrument which you can opt for. That instrument like ETF, EPF, NSE, post office relatively have lesser chances of default. So those who have conservative mindset and don't want to take any kind of default risk, you can opt for that. Then NCDs, non-convertible debentures of the companies, that is a little bit risky, but you can opt for the secured NCD instead of unsecured NCDs. Debt mutual fund, there are variety of debt mutual fund, like as I explained, the credit risk fund, or sometimes the guild fund, or that kind of mutual fund categories are available. So the main thing is purpose. So that purpose should be stability of the portfolio. And talking about the feature of the asset class is less volatile. There are some asset class who is giving a fixed return or income. There is an interest rate risk involved and default risk involved. So interest rate risk is a risk where interest rate may go down. So depending upon the RBI policy, return of that instrument will change. That is an interest rate risk. You can't fix it until unless you have a right product of debt. There are some GSEC or endowment plan where they are giving you some guaranteed sort of return. So they are the best solution for interest rate risk, because they are giving you a fixed kind of return for over a period of next 10 year or 15 year time. So they are giving you solution against this interest rate risk. Whether interest rate will go down or up, their return will be fixed. So that kind of debt instrument you can look for to avoid this interest rate risk. Default risk I already explained. Credit risk fund usually carrying a higher default risk, and in my view, this default risk is biggest risk I'm taking than compared to equity. Then this asset class usually is moderately tax friendly, because most of the asset class we have to pay tax as per the slab rate. So it is not as tax friendly as compared to equity. So this is moderately tax friendly asset class. Because why moderately? Because some asset class is giving indexation benefit. For example, debt mutual fund, if I hold for 3 years, I'll get the benefit of indexation. So these kind of benefit are still available. So that's why I named it as a moderate tax friendly. Then there is gold as an asset class. I'm sure I'm able to all of you. Is there any comment box or something where you can give me indication that I'm audible to all of you?
Nikhil, I think I can hear your voice very clearly.
Okay, great. So I'll continue.
But I think there is some in video. There is some you can say little bit bloodiness is coming. So might be some connectivity issues there. But your voice is very audible.
Okay, and this presentation is also visible, right?
Yes, depth, purpose, and feature. All 3 points are visible.
Thanks, Manish. So yeah, so now talked about gold as an asset class. So in India, I see gold is a emotional investment rather than fundamental or technical investment. It is an emotional investment. I met a lot of investors. They never listen to me when we talk about gold. They are saying that they have managed, whether the gold is on the higher side or the lower side, they have to buy, so they have to buy. So there is no alternative for that. So that is something emotional factor is over coming to the fundamental part. But to explain this gold asset class, I bifurcated into 3 parts. First is the physical gold, then second is gold ETF or gold sovereign bond. So I explained most of my client, to invest in gold sovereign and gold ETF rather than investing in physical gold. So I explained the difference between these 3. But in my view, purpose of having this asset class should be always hedging of portfolio. No, because usually if you see the global liquidity, if it will go to the global liquidity, if you see if it will go to the equity asset class, it will come from somewhere, come from selling of the gold or something like that. And when they see equity as a very expensive or sometimes uncertainty, so the best way to park the money is the gold. So gold is always play a role of hedging of the portfolio against equity. And we have seen in the last 6 months also, when the equity was falling down, so gold is taking appreciation at that time. So hedging of the portfolio is the purpose to having a gold. And the feature of this asset class is, it is highly volatile due to it is have a correlation with the equity. Also, I always told my client that gold is the only asset class which we can see as a currency, global currency, because gold is gold, whether it is in India or in USA or UK or China, gold is gold. So in my view, it is a global currency. So we should have in our portfolio as a global currency or hedge of the portfolio. Sorry. So there is no fixed return or income as such. Gold always invest for the valuation purpose. There is nothing like that. We are getting something return on that. There is a risk of quality. I'm sure, like on the physical gold, that risk is there. There is a carrying cost. We need to, if we are buying a physical gold, so we need to carry it. Most of us, we are taking, in bank locker, carry that, and we have to pay for that. This is again moderately tax friendly because fortunately there is a taxation benefit for long term. So it is moderately tax friendly. Also, there is some tax benefit on gold sovereign thing. It may, this avenue will generate tax free return on gold. So I explain you the difference between all. There are some parameters on which we can see the difference between these three. So investment limit, in physical there is no limit, but in gold ETF or sovereign bond there is a limit, or we can say there is a capping. So in gold ETF, minimum limit of 1 gram and maximum no limit, but sovereign bond, because government is giving some extra benefit, so maximum 4 kg per individual there is a limit. And then safety and security point of view, there is a risk of theft. Gold ETF, relatively there is safer until unless there is a big scam like we have seen NCSL was a scam, but relatively there is a lesser risk of theft. Gold sovereign bond, it is relatively safer than gold ETF and physical gold. In point of view, total return lower than the actual return of the gold due to making charges and other taxation involved. If I'm buying a gold of a lakh rupees, so entire 1 lakh rupees will not go to buy the gold. There are some other charges. In gold ETF, lower than the actual return on the gold because there are some AMC charges, but that is very minimum. Sovereign bond, that is very interesting. Here I'm getting a return more than the gold value because government will give some kind of return over and above as an interest over and above the gold value. So if we'll talk about on the return point of view, so physical gold will give the lesser return as compared to the gold appreciation, vis-a-vis like gold ETF and sovereign bond. So sovereign bond have a great advantage over this total return. Then taxability, GST is involved at the time of buying, and LTCG is applicable after 3 years. Here in the gold ETF, STCG, LTCG applicable after 3 years. STCG is there. There is a taxation. Sovereign bond, again interesting. Interest is taxable, whatever 2.5% we are getting over and above gold rate. But if I hold this bond, till maturity, it will be tax free. So if I withdraw in 5th year, so long-term capital gain will be there. But if I hold till maturity, there is no capital gain. It is completely tax-free. So again, taxation point of view, sovereign gold bond has a good feature. So can it be used as a collateral for loan? Yes. Gold ETF, no. But all these two avenues has thumbs up for that. ट्रेडेबिलिटी इट इज कंडीशनल लाइक आप किसी भी सुनार के पास जाएंगे, शॉप में जाएंगे, वहां से आप जिस किसी भी रेट पे लेते हैं, तो दैट इज द ओनली वे आउट टू लिक्विडेट और ट्रेड. In gold ETF there is a proper mechanism where you can trade and exchange. Here there is a lock-in of 5 years. After 5 years you can redeem by paying long-term capital gain, or you can hold till 8 years to get tax-free maturity amount. So liquidity, less liquidity in sovereign gold bond. Purity not assured. It depends again आपका किससे क्या relation है, आप किससे buy करते हैं. Gold ETF, it is assured, and sovereign gold bond, it is assured. Cost, it is very high because there is a making charges, cost of carrying, as I explained you, like you need to keep gold in a very safe place. So that safe place could be the banking locker or something where you have to pay some extra charges. Here there is a low cost because expense ratio is relatively very minimum, like because fund manager don't need to do anything now. There is a certain expenses, but expense ratio will relatively low in gold ETF kind of scheme. Here there is very low, only the demat charges could apply, but again 2.5% extra return is coming. So this cost is, basically there is no cost according to my view. Risk, there is a capital loss if market, the same risk is same in all three. Like if market goes down, so but the one point, due to this liquidity, this risk can be manageable in gold ETF because it is very liquid in gold ETF. So if I see like in next 6 months gold price will go down, so I can sell in gold ETF but can't do that activity in sovereign gold. So there are the feature of all the three avenues. Then liquid asset class is particularly like your hard cash or बैंक सेविंग बैंक में जो पैसा रखा हुआ है, ऑनलाइन वैलेट आजकल आ गए हैं, उनमें कुछ पैसा है, या फिर लिक्विड और ओवरनाइट फंड जो कैटेगरी है डेट म्यूचुअल फंड के अंदर, उसमें आपने पैसा रखा हुआ है. Relatively overnight fund is more secure than liquid fund because वहाँ पे average maturity of the fund is 90 days. Every 90 days money got matured and fund manager के पास वापस आता है और फिर से देख के invest करता है. So for a shorter term or ultra short term thing, we can park our money into overnight fund, in my view. And the purpose of this liquid asset class should be emergency corpus. Like we all should have a emergency corpus. So to create an emergency corpus or to mitigate any ultra short term goal, we should have a liquid asset class. And the feature is very less volatile, low chance of capital loss, but there is setback like return is not that can beat inflation, so value can be eroded by inflation. Low return, less tax friendly. Usually all liquid asset class return is taxable as per the slab rate, and that could be 30 or 42% depending upon the customer profile. Now the real estate asset class. So real estate asset class cover like flats, plots, bungalows, commercial properties. And the most interesting is the REITs. Like recently we have seen like Mindspace has launched the REIT fund. So REIT is a kind of asset class which can manage your liquidity. Usually the feature of the asset class is it is highly illiquid, and the price, like if you would like to buy a 2 BHK house, so for example, if it comes in 1.5 CR or 2 CR, and you have only 50 lakh rupees, so you have to take a loan. You can't invest that 50 lakh in 2 BHK, right? But this REIT is a solution for that. You can invest a fund where the underlying asset is the real estate, and you can invest that 50 lakh in those funds to get the appreciation or valuation of the real estate as a category. So the purpose of this asset class, in my view, is to maintain your lifestyle. It is an investment for regular income, or sometimes it could be legacy. So for legacy purpose also, because I have seen we are doing when asset planning, so we have seen if there are 2 kids, so generally father believe in that he should have 2 houses to give gift to both of the child. So that is the purpose of this asset class. The feature we have already explained, highly liquid, less volatile, but the risk involved in getting a bad tenant, market decline, we have witnessed last 3 or 5 years is the bad year of this real estate. And the most important is litigation, the legacy or so this legacy create this litigation part of thing, because I have seen like in family court, out of 100, 60% cases belongs to this property litigation. भाइयों में झगड़ा हो जाता है, या फिर सही से प्रॉपर विल प्लानिंग, एसेट प्लानिंग ढंग से नहीं हो पाता है, तो प्रॉपर्टी लिटिगेशन में चली जाती है. नॉमिनी कुछ और होता है, बिल कुछ और होती है, 2-3 बिल क्रिएट की हुई होती है. लॉट ऑफ लिटिगेशन इज हैपनिंग इन दिस एसेट क्लास. सो that create a big mess for this asset class, and we should avoid that by doing proper will or estate planning. and it is moderately tax friendly because there are so many benefits provided to this asset class. We all are CA, so we know like section 54, 54F, 54EC, where we can reinvest the same amount into the same asset class or in the bonds, or abhi to startup wala section bhi aa gaya, so it is moderately tax friendly. So these are the broad asset class which I have given the glimpse, like which asset class, what is the feature, what avenue is available, and what is the purpose we should define before choosing the right asset class. So now the point is, I know the asset class. So the point is, how to define my asset allocation strategy. So this asset allocation strategy basically, typically depends upon this three factor. First is time, second is risk, and third is financial situation, or we can say it, your goal. So on this three parameter, on the answer of this three question, you should define your asset allocation strategy. We should not copy the other asset allocation strategy to us. It is not advisable that my colleague or my friend is having 30% into this, 70% into this, or 20, 10, 70, like that. We should not adopt the same thing, because this three factor could change or could differ, or could priority can be differ. So like time, first of all you should define the time horizon. What is the time horizon available to achieve your financial goal? So if your financial goal is coming in next 1 year or less than 1 year, then we discussed like which asset class should be preferable to you. Sometimes people get excited, and if the time frame is less than 1 year, and they get excited and they invest the money in the market in view of that they will get a good return, but due to the volatility, they may land on the losses. So this time horizon is the thing where can dilute the equity risk also. So for example, if I have a time frame of 5 year or 7 year from here, so that equity volatility risk can be hedged by this time horizon, because I have a long time to invest in the equity market. So this volatility can be hedged due to this time horizon. So first we need to define like what is the time horizon available for me to achieve my financial goal. So this is very important element to decide our asset allocation strategy. This is something like people usually missed or overlooked, because risk appetite is a thing where we are correlating it with equity only. As I explained you, in debt also, if I have a risk appetite good, so people generally invest in credit risk fund. So credit risk fund has a higher standard deviation, and in my view it is higher riskier than equity investment. So risk appetite is a proper mechanism. There is a big companies who is doing the risk appetite only. So their main activity is risk appetite. Australia, US is very mature market to judge or to do risk appetite of an individual or the corporate. So it is very defined or very scientifically proved mechanism where you can have your risk appetite. So I've not covered that question, like on what basis you can define your risk appetite, but after knowing your risk appetite, you should choose the right asset class. So I'll give you the glimpse, like risk appetite question answer is based on your lifestyle, your behavior, your spending trends. So based on those answer or your aspiration, based on based on that answer, that form define your risk appetite. So but that is most important element. If your risk appetite permit you, so within that permit only you should choose your right asset class. Then the goal or financial situation. So we should know like what is your current net worth. So why it is important and why I have written here, a person like at the age of 60, those have a good net worth, like his all goal has been completed, their all kids are settled, and enough net worth to have a regular inflow for retirement. So this kind of scenario is available where we can take a decision like if time and risk appetite is permitted, we can take a decision on something aggressive kind of thing, something aggressive kind of asset allocation strategy. But a person on the other side has the only portfolio available at the age of 60 on which he is doing or he has done till so far his retirement planning. So if you have the only net worth to survive yourself, we can't take much risk, right? We can't, if my risk appetite is higher also, but I can't take a high volatile or highly risky asset class. So these kind of answer can help us, to find out the right or correct asset allocation strategy. So time, risk, and the financial situation will decide. These three factors will decide what should be my asset allocation strategy. So based on that, I can define conservative, moderate, or aggressive based on time, risk, and financial situation, my financial situation or my goal, like if any goal is pending or something, like then based on that I should define what should be my strategy. So broadly it is defined in conservative, moderate, and aggressive kind of thing. So also with this asset allocation strategy, rebalancing is also important. So for example, if a person initially started earning at the age of 20, so can take a risk, more risk according to his risk profile, and time is also permit because he is too young. So time is also permitting, and financial obligation, to be very frank, it's not there at the age of 20 or 25. So 20 to 35, if we choose asset allocation of 80% into equity and 20% into debt, then we should rebalance it according to the time. So the same person, if will enter in this slab 36 to 50, we should rebalance, like we should reduce the equity and we should add it to more debt. So this is just for the example. There are more other asset class which we have talked about, but this is just the example. So there is one thumb rule which is there in the financial planning area. That thumb rule is 100 minus your age should be your equity exposure. So like suppose age is 35 and 100 minus 35 is 65 is your equity portfolio. But what we evolved, as soon as you are reaching to your retirement age, that thumb rule has been changed as of now. Life expectancy minus your age should be your equity portfolio. So for example, if person enter into 50 to 60 area where he or she has only 10 years to land up for the retirement, so 80 minus 50, like 30% is equity. So this rebalancing activity should be there in the portfolio. Otherwise, it should not be static. It should be dynamic based on the age as well as the other scenario. Then proper asset allocation, for example, like 65% into stock, then debt, and then cash for emergency corpus, for real estate, for my lifestyle, or maybe that can be used later on for legacy, then gold for the hedging purpose. That is a good asset allocation. But diversification is also important within asset class. For example, this is the equity asset allocation, and within a equity asset allocation, there is a proper diversification. Proper diversification in terms of, like, in equity, that 65% equity, we could have 50% large cap, depending upon the risk appetite again, then 20% quality mid cap or mid cap stock, then 10% of small cap, 15% international equity, 5% unlisted equity exposure. That is a proper diversification within an asset allocation. That could be happen in debt asset class, as we talked about, for ultra short term, or in real estate also, like commercial, residential kind of thing. So diversification within an asset class is equally important to choose the right asset allocation. So I'm like starting from this market outlook, for timing the market to asset allocation strategy, then asset class, different asset class broadly into 5, then every feature of the asset class and the purpose, and then factor to decide our asset allocation strategy. Finally, to summarize that, I have something to you for as a final takeaway. So these are the 6 steps you should follow for to safeguard your money, hard and earned money. And if you are in this practice, so you can advise your client also. So first and foremost thing, you should have your emergency corpus. 3 to 6 months of your mandatory expenses should be in your bank account or liquid account. So that can denotes to the liquid asset class. So you can park that kind of money of 3 to 6 months of your mandatory expenses to certain liquid fund or in your bank account. That is most important thing you should have as the emergency corpus. Then cash flow, understand the difference between luxury and need. You should spend very wisely. Sometimes we have to relearn and unlearn few things, like goal priorities. Like for example, in the month of January, starting of this year, my priority was to have upgradation of my car. But we have seen like this lockdown came and a lot of disruption has happened. So it is not like that always we should stick to like what we decided in the year initial of the year. So sometimes we have to relearn and unlearn the thing, and we need to redefine our goal. So goal priority, like if I have that much money only, so I can keep it for my emergency over and above upgradation of that car. So that goal priority and all this thing should be on the basis of the change of the external or internal scenario. Then SIP, this is my personal experience. Don't stop your SIP in any market. Whatever webinar we have delivered in this lockdown, when the market was 7,500, we bluntly, telling our client to, don't stop your SIP. If you have very much cash crunch, like if you do not have an emergency corpus, for 2 months you can pause your SIP, but do not stop your SIP in that downtrend market also or the upward trend market also. SIP always, because SIP is denotes to the proper diversification and proper asset allocation, and that will beat the volatility of equity. So my advice to you: do not stop off your SIP, or if you have not started, you should start your SIP. Then financial plan or portfolio review. If you have not created your financial plan, I advise all of you just not invest into the market, because that will not counted as an investment, that will be counted as a speculation. First you should prepare your financial plan, do your homework, then create one portfolio, then do your asset allocation, then come to the product side, like which product can suitable or will be suitable for which kind of your financial need. So that will give the justice to the asset class, and that will give the justice to the avenue available in within the asset class. Because as I given you the example, if I am expecting a liquidity from real estate, so there is nothing wrong in real estate. There is something wrong in my side, because I have chosen for liquidity real estate asset class. Or the another example, if I'm choosing debt for aggressive or higher return, so again the thing is going wrong from my side, because I am choosing a wrong asset class. So and that can be resolved by doing this financial planning and portfolio review thing. You can do a proper rebalancing of asset allocation. If you haven't started, you should start. Or if you are in this practice, I must say that if you created financial plan, review is more important than creating your financial plan, because nothing is permanent in the world. You keep is changing, sometimes some external factor, sometime internal factor is coming up, so we need to be in line with that. Then no F&O, no short-term equity trades. That is my advice to you. It is nothing written anywhere in the law. You can do it. Is very much legal in India. But my advice to you: do not go for any kind of F&O and short-term equity trading. You should focus on your wealth creation, not on the speculation side. 6 is very important: notional profit versus real profit. Market is already having a fair valuation on the board, and right now like 13,000 crores nifty. So my advice to you: don't excite with the current scenario. Just convert your notional profit into real profit, because if your portfolio is giving you more than 15% return in equity, you should always realize it, because in a longer run we always have an expectation from equity for wealth creation point of view as a 12 to 15% return. And if it achieved so early, so that's good for you. You can book it and you can wait for the another opportunity. So for that also you can use liquid as an asset class. For example, if you have a 50 more than 15% profit in your portfolio, you can first switch from equity to liquid asset class, and then if you can't time the market, that is very true and that is applied for everyone. You can just apply the principle of asset allocation, and you can start STP, systematic transfer price, systematic transfer planning. So that systematically from that liquid fund, you will again entering into the market with different level. So that is my advice to you for money in finance. Then uh, just to summarize the market outlook, equity, I am seeing equity as a as of now as a neutral. Because why neutral? Because as I shown you the data of Morningstar, it is more than fair value or expensive. So I advise to book profit as of now, and realize your profit, notional profit. There is some for re-entering, like I advise, there are a lot of ESG flexi cap categories available. This ESG is something in India, it is evolving category, I must say. In developed country like US and UK, there is a proper ESG ranking for large cap stock, or each category of the stock. So in India also there are certain companies or certain funds, those who are very keen or very focusing on good ESG score rather than only on the return. So for example, this Tata Group is always has a good score of ESG, because their policies are making in a way where they are doing good for economic and social, and they are good for the governance. So this ESG category, economic, social, and governance ranking fund, can deliver a good return, because we have seen a lot of government policies is coming out where government is also promoting this ESG scored company get benefited. So we can't we are not aware, or we can't predict like that in near future what kind of extra benefit they could alive. But yes, ESG as a sector that can reduce my risk, because one filter I am doing, like I would like to go with the large cap company. Then in large cap also, I would like to go with a higher ESG score, not on the higher valuation, or not on the higher return side. I am banging on the higher ESG score. Those companies who are focusing more on their ESG part, ESG contribution side. So this ESG flexi cap can be a good option to re-enter into the market. Lot of NFOs, you are I'm sure you have been heard on that. A lot of NFOs is also coming from the mutual fund side, and government is also promoting this ESG as a category. So change your SIP accordingly. Do review each and everything in equity. Equity, most important thing, equity take time. Take time in terms of advising. Take time in terms of as an investor. It requires more patience from your side. So as of now, my view on this equity as a neutral. Talking about debt, I have given negative sentiment on debt and negative ranking. Why? Because that is my personal belief that again, I may be wrong. We are at the lowest repo rate or interest rate scenario, 4%. RBI want to reduce the rate because they would like to participate with government, to revive the economy, but they have a biggest fear on the inflation side. So if the inflation side is higher, they have to increase the rate. So the number which we have seen, the CPI index, it is under control, but if CPI index will go upward side, so they have to increase the rate. And as soon as they will increase the rate, all the debt mutual fund can give you the negative return for short term. So you can see if RBI policy will come, like they are reducing the rate, so we can see in a shorter term there is a negative return. So in debt side, if you have a debt mutual fund or something, you should be very cautious, because liquid fund or debt fund may deliver negative return for short term period. So change your thing accordingly. Um, Also on this debt asset class, interest rate risk and default risk is there. So default risk is bigger than this interest rate risk. Default risk you can avoid by choosing a less riskier instrument, and interest rate risk you can avoid by choosing a good guaranteed return for long term horizon. There are some instrument available, so you can choose those instrument to hedge against this debt default risk. Gold, still I'm positive because it is a good tool to hedge your wealth. So depending upon your risk appetite or your wealth scenario, you should have 10 to 20% of your portfolio into the gold. And gold, as I explained you, there are three things. One is physical gold, then sovereign, and then ETF. If you want liquidity in gold, you can start with gold ETF. But if you don't want liquidity, so sovereign gold bond have a good benefit over and above gold ETF and physical gold. So gold, I am very bullish, very positive still on this sector because I see gold as a currency, not as an investment. Real estate. Earlier, I was on the neutral or negative side, but I changed recently that it is positive in my view because if we see residential, there is already correction happened up to 10 to 20% in this COVID period, this lockdown period. Also, there is a lesser stamp duty, especially in Maharashtra. And I have heard the statement of ministry that they, instructed or advised all the state, to reconsider their stamp duty to revive this sector. So the major dent was a lot of reforms happened in this real estate sector. That's why the things, went wrong in last 4 5 years. But corrections happened. Now we have seen the stability, and in the last month, real estate index is also, giving a good sign of recovery. So correction is already done. So you can look for your residential thing. Basically affordable or affordable housing. There are some other benefit also from the government side, like there is an interest link subsidy scheme is going on. If you are the first home buyer, government is giving some 2 lakh odd amount as a incentive or waiver of interest kind of thing. So these are the factor which this reviving this real estate sector. For commercial, usually for higher rental yield, we take commercial over and above this residential. But in my view, like as we have seen in this lockdown, work from home, IT and other major companies already declared till 31st March. And a lot of cities like Bangalore or Hyderabad, where IT driven, or Pune, they all are the IT driven. And that IT driven company has done the cost cutting, and they have decided to do work from home till 31st March. So there is a strong possibilities that this will hit hard, and distress sell you will see in near 2 3 months. You can see a good deal on the commercial side. But if things go again on the revival mode, so commercial always have a good higher rental yield than residential. But as of now, I recommend you don't go directly into the commercial just because of higher rental yield, because there is a dent on the rental side, because major companies has adopted work from home policy. So real estate, I look positive, and don't see real estate as a Mumbai itself. If you see the tier 3 or tier 2 cities, where the range of the real estate start from 30 lakhs to 80 lakhs. So their major traction is happened in last 2 3 months, the data which I have read. So the small inventory, again, it is going to revive this sector. So still, I am hoping good on this real estate sector. Insurance, one thing like COVID has taught us, like either we should have a big corpus for emergency, like health emergency, or we should have a small premium to pay to hedge against that kind of uncertain scenario. So my advice to you, insurance, you should have a take decent term insurance, also health. And also there are some critical illness plan where there are defined critical illness, 30 or 32 or critical illness are there. If you diagnose that critical illness, you will get that amount. So here we need to understand the difference between health insurance and critical illness plan. Why should you have both the plan in your portfolio? because the health insurance is like that. If you diagnose something, you admitted to hospital, there are certain criteria like that disease should not be like uh, I mean, like there is a holiday period of disease like 1 year, 2 year, or 3 year, or 4 year, depending upon your health insurance plan. Then you get you first you spend for that expenditure, and then whether it is cashless or to claim back, depending upon that you are eligible for, or you are utilizing that health insurance. But there are other expenses, like suppose if you are coming from small town to some big cities, so health insurance doesn't cover staying cost or food cost or other costs. So health insurance will cover only the part of related to that is covered for that treatment. But critical illness worked in a different way. Critical illness is a plan where company will pay you the entire amount in your bank based on diagnosing of that disease. It means if you are not spending any single amount on your treatment also, you will get that amount based on the diagnosis of that disease. So if you have both the things, so you can hedge yourself against all the expenses. So for the critical illness, whatever amount you are getting, you can use it for your traveling or your other expenses. For example, you might not have job due to major health treatment. So 2 months or 3 months or 6 months you are at home. So that critical illness amount, you can use it as a source of income from this critical illness, and you can use it for your household expenses. So these kind of planning you can do, and health insurance will cover up the treatment of the cost. So that is the basic difference. So you should have all the parameters and all the plan in your portfolio to hedge yourself against any kind of uncertainty. So again, diversification we have discussed. Do not put your all egg into one basket. Diversification we have seen, return versus reward also. It is always good to do diversification. And at the real estate, again, like I am bullish, positive. Air and travel, I am still negative because there is a lot of thing still to open, and guideline related to traveling and other thing is yet to normalize. So this industry or this sector is still going to revive. So my rating to this is still negative. Oil and gas still negative because again this industry is facing another issue. Like there is a proper other session I can take on this oil and gas, where the Saudi, Russia, US, what is happening, and all this thing, and that chaos is creating affecting this sector a lot. Banking and insurance, I'm neutral at that point of time because a lot of liquidity is there. Their books is looking good. In fact, I have read a lot of article where they are bullish on this banking sector for Q3 and Q4. But my point is that जब तक हमें पता नहीं हो, uncertainty हो, we should hold to invest or something, because this banking sector, the biggest risk is that how much big or deep dent of that NPA or restructure of their loan size. So अभी वो पता नहीं चलेगा, अभी के जितने भी रिजल्ट है उसमें पता नहीं चलेगा. But Q1 next financial year definitely define karega. So as of now I'm neutral, but some of you will read that they are hoping good hope on this sector, and index of banking sector is also reached to the pre-COVID level, and it is now more than the pre-COVID level. So automotive, initially we were negative on that sector, but like we have seen like how we are reacting on the automotive side, and it is not bad as we are expecting. So we changed the impact on this sector is positive, because there is a difference between need and luxury. So we have seen like car range in the 10 to 15 or 20 lakhs is the hot selling product. So luxury is still there is a lacking, but up to 20 lakhs car people are spending, and their number is telling a true story. What we predicted was wrong, and yes, the impact as of now we are seeing is a positive as of now. Pharma and healthcare is positive. Again, FMCG is positive. IT is positive. Mining and metal, I am told you already that this is a debt-driven sector. So I will not go any debt-driven sector as of now. So my view is negative. Consumer durable is positive. We have seen this festival season also people spend more, and this sector is looking good. So out of this all sector, pharma and IT is already taken rally in market point of view, but FMCG and consumer durable stock, in my view, still have a good potential, and next 2 or 3 years you will see a good rally in this sector. So for 2 or 3 years, if you are expecting a good return, so these two sector could be a good bet, to invest into, because pharma and IT is already taken that rally. Pharma, though, like COVID and everything is digested, but still we are hoping on pharma and IT also, because IT is now the backbone, and work from home culture. IT is essential for every company, but still FMCG and consumer durable, we can see a good rally. So yes, opportunities lies in every problem. Government, everyone is hoping that they can replace some part of supply in India, and that could benefit it in any way to us. So I think I'm done from my side. I try to cover all the aspect as far as my knowledge. I would like to have some question if you allowed me, because the time is 15 minutes is left. Over to you,
Nikhil sir.
Manish.
Nikhil sir.
Yes, sir.
Nikhil sir.
I request everybody to ask question one by one. So the question
Nikhil
is
sir.
audible. And
Yeah,
people will be able to view.
निखिल सर, आपको मैंने ऑर्गेनाइजर बना दिया है. जो आपको जो कंट्रोल पैनल है ना गो टू वेबिनार का, वहां पे देखिए क्वेश्चन का ऑप्शन आ रहा है. तो जो क्वेश्चन है सर आप देख सकते हैं. कंट्रोल पैनल में देखेंगे ना तो क्वेश्चन का, चैट का, ऑडियो का, तो वहाँ पे क्वेश्चन देखेंगे, क्वेश्चन का ऑप्शन आ रहा है, तो वहाँ पे क्लिक करेंगे ना, जितना क्वेश्चन है आपको दिख जाएगा.
Okay, so there are questions asked by. So let me go through first this, and then I'll take pick one by one.
Yes.
I think. So, like, there is one question relevant for the topic is like asked by Harshad. There are many couple of gold ETF in the market. Could you provide some information on how identify which gold ETF should be preferred? So gold ETF basically like it is electronically trade fund. So there an underlying asset is gold. So you can choose the brand wise like which AMC you prefer. For example, SDFC, Axis, SBI, or there are some new emerging AMCs also. So you can choose a good AMC because underlying asset is same, and also you should look the expense ratio, because it is a gold underlying asset and it is ETF. So fund manager really don't need to do anything much into that. So which good branded AMC is giving you the lesser expense ratio, you should prefer that. Why age is important for investment? Age is very important for investment, but age not only age is the criteria. With age, we need to see the financial situation and the timeline of the investment. So in that three things together, if we'll see, the age is important play, because if my financial goal, if I am not that net worthy person, and my age is near to retirement, so my risk appetite is not be that much for aggressive asset class. That's why age is most important part.
Nikhil, I will have one more question to add to that gold ETF. So there are we have options of investing in gold ETF, and there is a sovereign gold bond. Comparing both the two, which is more advisable when it comes to investing directly into gold? Because I suppose in sovereign gold bond we get some interest also fixed monthly, and at the same time there is no expense ratio when it comes to sovereign gold bond, and also there is a tax benefit if we hold till the end of maturity.
Yeah, Manish, I explained and I covered in my presentation also.
Yes.
Gold sovereign bond has a good feature as far as related to returns. Like there is 2.5% extra return over and above the gold appreciation. Taxation benefit is also available if you hold it till the maturity, that is 8 years. You will get tax-free return. After 5 years, you will get indexation benefit if you would like to exit. The only thing is or the only drawback of the gold sovereign bond is liquidity. Suppose if you'd
Correct.
like to manage the liquidity, or you would like to buy sell depending upon the pricing of the gold, so that feature is not available in the sovereign bond, but you can do it with gold ETF, because gold ETF is liquid than gold sovereign bond.
Okay, I got you also.
So there is one question which is very okay. I read out first this. Can you show the asset allocation chart? If someone has a house and housing loan, then can he have his balance investment in direct equity MF? So if you have housing loan, so generally what we do, we take that asset class as a net, because the loan should be subtract from the net worth. So if I invested, let's say 1 CR, and there is a loan of 80 lakhs, so 20 lakhs is the amount which we take for the purpose of asset allocation chart. So rate appreciation would be on the 1 CR, but on the same side, when we do the rebalancing or review of the portfolio, so that percentage can be changed accordingly. So that is very execution kind of question. So still you have any doubt, you can write on my email ID. I can share some Excel or some sort of thing. If return are 50% from direct equity in a year time, should that be booked? 101% that should be booked. I'm not sure about your strategy, if it is for trading purpose or wealth creation purpose. But if the return is 50%, so my answer is yes in both the cases, in trading as well as the wealth creation. Because in wealth creation, this 50% return we can't expect. So generally in our financial planning, we create a sheets for forecasting of the future cash flows, or the valuation of the equity with 12% or 15%, depending upon which equity avenues we have chosen. So 50% is a very good amount. You should immediately book the profit, and you can again re-enter depending upon your if you are a trader, so you will definitely reinvest it. But if you are an investor also, you can reinvest again into the market. As I explained you can book profit and you can take money into liquid fund. Then from that you can start switching STP for next 6 months. So आने वाले 6 महीने में धीरे धीरे करके आप वापस मार्केट में चले जाएंगे. So it is like SIP for 6 months. Thank you, Rahul ji, for your appreciation. Can you suggest some good ESG flexi cap? Sir, there are, this is evolving category. So right now, like SBI has, SBI Magnum ESG is a good ESG flexi cap fund. You can see the returns on any, website like Morningstar or Value Research. But there are a lot of NFO is coming out. So Axis is one of the AMC who is taking out the NFO. Kotak is also one of the AMC. Those NFO is going to be closed on 4th. So you can look all these three AMC. These three AMC is good as far as my knowledge. How we can share, how we can invest into share of companies outside India. So, sir, there is a proper mechanism has been developed and approved by SEBI, RBI, FEMA, everywhere. So if you are aware that there is LRS scheme, liberalized remittance scheme of the RBI, where you can fill A2 form and you can remit money outside India for the purpose of investment itself. So there are a lot of platforms. One of the platform is the Stockil. So in fact, like you can go on the Fin2 in my contact information I have mentioned. You can go www.fin2.in where there is an option of international equity. So it is very simple. Based on your KYC, one account will be opened and you can remit the money into that account. In US, there is no concept of the demat. There is a custodian. So the city or some larger custodian is a city bank over there. So through that custodian, you can buy and sell the shares of the big companies like Amazon, Tesla, Netflix, and so on. So through that route, which is secure, safe, you can go and you can invest. How we can invest into share of the companies outside India? Can you tell about? I think I've covered this. Yes, gold ETF is a good option. It provides you liquidity, but if you have a time for 8 years, go for the gold sovereign bond. Thank you, Praveen ji, for your appreciation. Thank you, Vaishali. Yes, gold ETF is safe, but like there is no guarantee as such if you are talking to me. So to be very frank, you should choose a good AMC to choose a good ETF fund. So it should not be a very small kind of AMC. They are struggling for the liquidity. So like SDFC, SBI, Axis, I explained you Kotak. You can go and you can take gold ETF fund. It is much safer. Can the presentation can be shared? Yeah, please, you can write me on my email. I will share this presentation. I'm investing in very specific few companies and study it regularly for big question like climate change. How can I know their strategy? So for that you need a detailed in-depth thorough study of the paper. So what to the extent of this question I can answer you in that way. For climate change there is a in annual report as of now auditor is commenting on that part. Internal auditor is also commenting on that part, so you can read some data from there. So on climate change, like what company is doing and how they are doing good. But if you don't want to invest so much in depth into that, so ESG is a better choice for us, because if the ESG score of the company is good, so you can see that their climate change policy is good for the country or for the economy. Gold ETF pay dividend, yes, that is a like in mutual fund there are three kind of investment in any category. One is growth, another is dividend payout, and the third is dividend reinvestment. Is ITC is the FMCG or cigarette company? I understand. So ITC initially or landmark company of a cigarette company itself, but they are going to change their image, and they would like to call it as a FMCG, and that is that dilemma itself affecting that stock price in my view. So in FMCG, they have a biggest competitor like HUL. They have a good, strong book and strong values than ITC. And ITC has, the landmark company for the cigarette and tobacco company. So now they would like to market themselves as a FMCG company is affecting the brand of the company. So during 20 but not performing due to ESG norms, do you think the stock would to hold for next 5 to 7 years? ITC for 5 to 7 is a very long horizon. There is no harm, but you can look for other option also in this FMCG, like Marico is there, and HUL is also a good bank. So as compared to ITC, there are these two good stock, but ITC is not a bad stock in my point of view. But recently, because they would like to change their image from a cigarette company to FMCG company, they will take more time. And again, they are doing something which they were not doing at that intense level. So there is a risk involved in that part. So that you should aware about it. And if you would like to remain invested in FMCG, you have other good option also. Does equity goes up when gold goes down? Is there inverse relationship? Prima facie, you can see like yes, there is some inverse relationship between gold and equity. That's why we are choosing gold as a hedging asset class of for the portfolio. There is a big answer behind this because गोल्ड में कैसा होता है कि जब एक पूरी की पूरी कंट्री फॉर एग्जांपल एफपीआईज के नंबर इक्विटी एफपीआईज के नंबर आ रहे हैं फाइनेंशियल एसेट के लिए सो अगर उनको लगेगा कि इंडिया की ग्रोथ स्टोरी अच्छी नहीं है तो वो नंबर कहीं ना कहीं गोल्ड में जाके पार्क होंगे और गोल्ड इज अ ग्लोबल करेंसी तो गोल्ड में जब नंबर पार्क होंगे तो ओवरऑल डिमांड सप्लाई रूल लगेगा सो कहीं ना कहीं गोल्ड के प्राइस अप होंगे और इक्विटी के प्राइस डाउन होंगे so that's why there is a initially inverse relationship between gold and equity. You can note down my email ID. I'm not sure because I have. I don't know how to. Okay, here is the option to answer it. I think you can note down. It's Nikhil Nikhil.s as for Sharma @prnam.in. You can write any query or any question which I'm not able to answer here because I think time we are shortage of time. It's already 8 o'clock. So thank you so much for this opportunity. Special thanks to Mr. Lalitji and Manishji. Thanks for organizing this and giving me as an opportunity, to interact with my colleague. And I can say one thing, like doing as a traditional practice like taxation and audit. This is very dynamic field. As a CA, you will feel very excited or very much delighted to advise to client on this aspect as well because I met so many CFP guys or CFA guys or MBA guys who is into this field, but I feel that the knowledge or the in-depthness which we are holding as a CA degree they do not have. So I will be happy to see more new faces with this kind of era of practice. This is going to be evolving market, this wealth management and financial planning. You can talk to your client, those you are doing for audit and tax advisory. So you can ask them to give a chance for wealth advisory front where you will prove better than any other person. That is my gut feeling. So I over to you, Manish ji now.
Yes, sir. Thank you, Nikhil. Nikhil, you started with the burning issue. Why the stock market in India and in the world is going higher and higher day after day. And you addressed it very well. Also, you had explained the sectorial impact of about the economy and about the RBI and the macro level which is going on, and how really we can safeguard our principle. Also, we can earn the money. I think you touch upon almost all the asset class. There were certain complex asset class such as REITs. Also, you made it simpler to understand for normal, you can say young Cs also. And there have been many new asset class like sovereign gold bond or other investment which has been created in last few years. That also you explained, and also it will be helpful not only as an investor, but also we can really make this as a profession also. But at the same time, when it comes to new investment or new opportunity, it is said that initial entrance gets the highest cream of the pie because they are the pioneer to start with. So today your session has helped all the members attending to really take the informed decision, faster decision, and a smarter decision when it comes to protecting their losses, also making a very good amount, and you can say wealth creating of for themselves and their clients. And maybe that can also they can make this as a professional opportunity also. So I thank you for your time, and you are full of energy. From 6 to 8, you're taken non-stop, and I've never seen you are getting tired. So it really shows your dedication to the topic and to the subject. Thank
It's
you
just
very much.
because of you and the beautiful audience, like those who are listening. So everybody is contributing their time. So it's our moral responsibility, to deliver best
Yes,
from us. So thanks once again,
yes,
Manishji, for giving this platform to me.
definitely, Nikhil. And maybe we'll be in touch if there's any meeting or any forum. We'll request you to really give some time for us.
Sure, Manishji.
And with this, we declare conclusion of today's meeting. And we will maybe if there's any meeting, then it will be published on the WRC message board also regularly. Thank you very much.
Thank you. Good night. Good night to
Good
everyone.
night.
Thank you.